Blog Talk Radio.
Good evening, America, and welcome once again to Business Credit Radio. Today is September 26, 2013, and it's 6 p.m. Central Time, and we're very Thank you. We're very happy to have you with us tonight. We have another great show coming up for you. Specifically for you, I want to say thank you to all of our friends and peers from all over the world in the credit and finance management profession who's made it a point to join us, especially our loyal listeners. Thank you very much. And I also want to thank, as long as we're in the thanking mode, I want to thank CMA for being our sponsor.
This evening's show is partially brought to you by the Credit Management Association, a proud affiliate of the National Association of Credit Management that has helped business-to-business companies with their credit, collections, and financial decisions since 1883. Contact CMA at www.creditmanagementassociation.org for more details on how CMA can benefit you.
Thank you. I want everybody to remember that Business Credit Radio is the voice for credit and finance professionals worldwide. I'm your host, Phil Philbin. We have no co-host tonight. I want to talk to our potential callers. Callers, when you want to call in, you want to talk to our guest speaker, you dial 347-989-8342. Now, one more time, that's 347-989-8342. I have a little studio here in front of me on my screen, and as soon as you dial in that number, your number pops up on my screen, and I'll identify you by area code number, and then you get to come on, talk to our speaker, and ask him any question that you like. Or you can talk to me if you want as well. Today we have, again, one of our real good friends and honored guests, Mr. Norman Taylor. Norman has served as a director or manager of credit, accounts receivable, pricing, and billing in a wide variety of industries. He has also worked independently as a receivables consultant. Mr. Taylor is currently employed by NIIT Media Technologies, LLC, in Augusta, Georgia. He served on or chaired numerous creditors' committees in prominent national bankruptcy cases. He was one of 13 authors of the Principles of Business Credit, the text from which the NACM, the National Association of Credit Management classes, are taught nationwide. He authored several text or management guides used by various firms, the Pocket Credit Assistant, the Pocket Guide to Credit Insurance, the Pocket Customer Visit, a seminar leader or class instructor on various financial and professional topics involving cash flow analysis, demystifying the cash flow statement, international credit, public speaking, accounting, business law, and personal finance. So, with no further ado, today's discussion is understanding credit insurance, which is something I really need to get into. Welcome, Norman. Thanks for being here, and I hope we have a good discussion tonight.
Okay. Well, thank you, Phil, and thanks for having me back again. I think if I'm counting right, this is number 5, and I appreciate the blessing of being able to do that. As you say, tonight we're going to talk about business credit insurance, and I'm going to start with just a very brief definition of what it is. It's designed to, as I say, the topic's business credit insurance as opposed to just business insurance. And it's designed to protect against customers going insolvent or defaulting on payments, except in the event of a dispute. And the minute a dispute raises its head, there's a problem collecting from your credit insurance. So we'll get back to that a little bit more later, but I remember one particular case I had where a debtor simply filed a court order that said, or a court notice that said, I have a dispute. Just the word dispute, no no backing up or supporting of it, and immediately the insurance company declined to pay the claim until we resolved the dispute. So that is something that can happen to you, somewhat akin to disputing credit cards and so forth. But I'm going to go with here with a little brief history of credit insurance. Most forms of insurance arose from either a single catastrophic event or a series of events. For example, fire insurance didn't exist before the Great Fire of London, and that single event gave rise to fire insurance. Marine insurance did not generally exist until the 1800s, where the growth of merchant trading gave rise to the need for marine insurance. And the somewhat insignificant event that gave rise to credit insurance is not really insignificant. It's nothing less than World War I. In post-World War I era, there were countries, of course, which the credit strength was very poor, both for the country itself and for the customers within that country. And the governments saw the need to, Western governments saw the need to underwrite credit insurance. And as we know today, there are government programs that you can obtain that will insure you. But more likely, there are private insurers who do this these days. The private sector has stepped into this and replaced a lot of the government insurance that used to be done. So that's what caused this particular instrument to come into play. Now, what we're going to do next is compare credit insurance to other risk mitigation tools. And I'm not going to attempt to cover every other risk mitigation tool out there, but I'm going to talk about industry-specific government programs, factoring, and credit insurance. There is a program in the textile business called GSM 102, which guarantees your overseas shipments of 100% American product to a foreign, to an export customer. It is very, very paper intensive, and but interestingly enough, it covers not only agricultural products but anything that's 100% U.S. content. We used it a bit in the textile business. I was actually the first person in textiles to use GSM 102 for shipments of yarn. And so, because it was 100% cotton yarn, now any imported yarns that had gone into your fabric would not be covered, but you could use the GSM 102 program for 100% government fiber, 100% American fiber. So next we'll talk about factoring, which amazingly a lot of people really don't know much about factoring. It's particular to certain industries. When we wrote the Principles of Business Credit book, there weren't very many of us on there who knew much at all about factoring, but there were a couple of us, and we went together to write the chapter on that in the book. But basically, factoring is selling your receivable. You part with title to it, and I'm going to stop myself right there because there are more shades and varieties of factoring than you can imagine. But generally, it's used to just outright sell the receivable, collect the cash, and let the factoring company collect it for you. Sometimes you can collect it yourself, and the existence of your factor is invisible to the customer. But generally speaking, you sell the receivable, the factor goes about collecting it, and you don't really run or maintain much of a credit department. Now, the great thing about factoring is it's a cash flow generating tool. Unlike credit insurance, factoring will provide you with ready cash because you're selling the receivable outright. And you can, in certain circumstances, take advances against your receivables. So it's a nice cash flow tool. The bad thing about it is it's expensive, and the second bad thing about it is that it often doesn't give rise to a credit department with a credit knowledgeable group of people within your own company. And also, you have the problem of recourse, where unless you're extraordinarily lucky, Factor will not cover every customer that you want to sell. So you have to decide whether to sell a customer on recourse and that you'll take all or part of the risk because you need that customer that badly. And as I said, in a lot of factory companies, there isn't necessarily a strong credit department within to deal with things when you get over on that side where you're having to make the credit extension. Now, credit insurance, on the other hand, is not a cash generation tool, of course.